Hello everyone, welcome back to Forward Finance, and today I wanted to bring you a really interesting company that I'm pretty excited about. It's a small cap, very small company relatively speaking, about 63 million market cap at the moment, but they are pretty promising in my opinion, and it is a textiles company called Jerash Holdings, ticker JRSH, traded on the New York Stock Exchange, and it is I think quite a bargain at these prices, and I'm going to show you why. So what this company does is it's B2B, business to business. They don't really sell anything to consumers. They are selling custom clothing, custom apparel to a number of brands, international brands. You can see here they have some stuff on their website. So for example, we can look at their brands. They make apparel for Columbia, CostCo, Hanes, Russel Athletic, North Face, PVH, Walmart, VF Corporation. Most of you are probably familiar with most of these. These are big brands. Walmart has a lot of their own companies. Russell is also carried by Walmart and other stores. The North Face is actually quite a high-end brand, at least where I am. And Columbia as well for certain materials. Costco is massive. So that they have some quality customers, about 19 brands at the moment, and these are some of their larger ones that they like to highlight. And the thing about this company is it's a very small market cap. It hasn't recovered its losses from before the coronavirus pandemic, but I want to show you the way it was trending before everything hit. So they were founded back in early 2016. This is the end of their fiscal year 2016. So the thing to understand is this company, their fiscal year, meaning their accounting year, the way they report their numbers, it's just some companies do this. It's not January to December, it's March to March. So their fiscal year ends on March 31st. So each of these periods are reporting for the ending of March. So for example, this is the period from March 2015 to March 2016, and then the following year and the following year. But as you can see, the thing that we really like here is obviously their revenue going up every year, quite a bit of growth. This is a little bit more than 10% growth, a little more than 10% growth. Then it starts accelerating. We hit the hitch here because here March 2021. This is expected. This is up until March 2020. So this ended. This period right here, fiscal year 2020 ended in March of 2020. So the full effects of the coronavirus pandemic on their revenue earnings was not felt yet, because this was really in the United States when things were really starting to kick off, when the cases were starting to explode and stuff like that. So that's why for fiscal year 2021, which will end in about 2 months from now, they will report the fourth quarter for fiscal year 2021. They are expecting, as you can see, a revenue decline because of the effects of the pandemic, as a lot of companies are. And that's part of the reason I think it looks like a bargain right now. We'll look at that in a moment. But they are expecting to, and the analysts are projecting, to get right back to that growth, both in revenue and, as you can see down here, in earnings. And that will reflect that in our more deep analysis here. So I prepared this right here to look at their numbers. So as you can see again, from 2016, 2017, 2019, all the way through to 2020, fiscal year revenue up. This is before really, maybe a little bit effect of pandemic here, but not much. They still grew from fiscal 2019 to 2020. Earnings also a little bit, not totally up there, but they're doing some reinvestment though. As you can see, capital expenditures there. That's them reinvesting. They built more factories. Originally they had one factory, something like that back in 2016. Now they have 3 or 4 that they have operational, and they intend to increase that later, to keep growing as demand for their services increases from these brands and as they get more customers. And their debt, they have very, very little debt. They have more cash, really. That's why they have net current assets over here. So this net current asset value I'll explain in a moment. But they have more cash than they have debt, so there's no issue with debt. This is total debt, $13 million, but their revenue is 7 times that, something like that. It's no problem at all. Their earnings is almost, could have extinguished the debt this year if they wanted to. Taking, a little bit more debt, but it's not really long-term debt. It's just kind of, this is total debt. This includes long-term liabilities and short current liabilities. So as you can see, yeah, they have really low debt to EBITDA, meaning their debt divided by their earnings power, gross earnings power before interest, taxes, depreciation, amortization. So fundamentally, it's a small cap though. There are some risks with it. They're not that strong against competition, perhaps, if somebody tries to move in them. That's something to think about. But I really like the play here. I mean, if they can continue this growth, they will continue to grow, and that will reflect in the share price as earnings and revenue continue to rise. So they have some cash flow to operations here, some pretty nice free cash flow yields at this time. Like last year, it was 13%. Pretty nice. Continuing to grow earnings. They had a dip here, but that's fine. A hiccup. The trend is up. The trend is up, as we can see, with both the revenue and the earnings. So and on a valuation basis, as I was going to say, net current asset value. So what this is really nice. This is when you go down here, you have current assets, and I did a conservative calculation, which means I discounted inventory and I discounted accounts receivable. I do that by 20%. That's just my practice. You can see the 0.8 here, meaning I discount 20% of the actual reported numbers. Just, like sometimes a company can't sell things on time, or they will discount what they sell or something like that. Or their accounts receivable is bills or products that have yet to be paid that their customers have placed orders for, and just in case they don't receive some of the orders or something like that. And then inventory I discounted as well, 20%. I do this regularly just as a conservative figure. So their actual reported current assets is a little bit larger than this, but to be conservative I did that, in case there's damage to a facility and they lose some inventory, something like that, just kind of these unpredictable contingencies. So I like to do discounts on those values there. And as you can see, they have very, very low current liabilities. They have pretty much no debt. That's why the 12 is almost equal to the 13, because it's just, this is just current liabilities, like the electric bill and their payroll, and all the things that they have to pay month to month or quarter to quarter. And that's it. They're really, really pretty cheap on this kind of basis. Almost no debt, revenue growing, earnings growing, and they look like they're gonna bounce back. They're gonna get right back to revenue growth and earnings growth after the effects of this pandemic are fully, taken care of. The vaccine gets out there and people get back out there and are shopping a little bit more online. This company doesn't care if it's online or in person at the malls, wherever the people buy clothes. That doesn't matter to them. The retailers will order from them for e-commerce or brick and mortar shops. It doesn't matter. But the stock price, during the pandemic, I was accumulating. It looked really cheap, and it's still very cheap. I mean, this is still only 60. It's a micro cap, less than 70 million market cap, $42 million enterprise value, and they don't have that many shares outstanding, only 11.3 million. And they do pay, as a bonus, while you're waiting for it to appreciate more, they do pay a small dividend. It's yielding at about 3.4% before market open today. That's a nice thing. Then in the future, if they grow, after they've grown a lot, I would expect that they will eventually probably raise that. And it's not a problem for them to pay. The payout ratio is fairly low. That's for example, that's less than half of their trailing 12-month GAAP earnings, so less than 50% payout ratio there on earnings. And as you can see here, and again, indication forward PE, meaning this is their current PE, but their forward PE is about 10, because their earnings are expected to be higher for 2021, as we saw with the projections for growth in earnings and revenue. So yeah, I think this is a really nice company, opportunity in a micro cap though, so be aware of the risks here. It's a small company. It can be, somebody the barrier to entry is not that massive. They do have some advantages, such as being where they're located, low taxes, stuff like that. We'll talk about more about that. And yeah, I will continue to cover this company. I will bring out the news as it unfolds with what they're doing, and any developments and everything. And so please just subscribe, hit the like, hit the bell, so you can get more on this company. And if you have any questions about this company or any aspects that you want me to look at, or if there's any companies that you'd like me to do an analysis on, give my opinion, give my take, just leave in the comments down below. And just a disclaimer, this is this is not investment advice. So before you invest in anything, do your research. Make sure you understand the companies that you're investing in. You shouldn't invest in anything you don't understand. You shouldn't listen to me or anybody else, just telling you to buy something or anything like that. That's not what I'm doing here. But I do want to share my take. This is my opinion on. I think that this is a solid company, and that's why I have personally purchase it in my portfolio. So, okay, thanks guys, and again, leave the thumbs up and subscribe, and I'll see you in the next video.